Okay, here we go. After all of this time, we are finally ready to dive into Module 2 Technical Analysis. This is the first lesson in the course. We had a lesson 0 that I uploaded a bit earlier this week that was more or less breaking down the Thinkorswim platform and a lot of the tools there. We have my chart set up here, and now we get started in the real first lecture. This lecture is going to be twofold or sixfold, however you want to put it. The first section will be covering the two dimensions of charting, price and time, while the second portion will be covering the four components or different types of technical analysis. Those four parts are trend, momentum, volatility, and volume. Each of those will have their own individual lectures breaking down all of the indicators and whatnot, but we are going to very briefly cover all of these topics today, starting with a deep dive into price and time. These are subjects that are fairly well known, but I do want to reiterate them fairly strongly and make sure that this is very well understood. Hopefully you learn a thing or two when just learning about price and time. For starters, I did remove the volume section here just so we would have as much charting space as possible for the actual lecture. Now, what we're going to do for this lecture is, rather than looking at a larger time frame, we are going to look at the 1 minute time frame for some reasons you will see shortly. But without further ado, let's jump right into lecture 1 of the technical analysis module. All right, let's talk about price. So when it comes to technical analysis, price is truly, price and time are truly the only things that are absolute. Everything else is essentially fluff. Every technical tool, even volume to some extent, is relatively fluff. Price and price alone are what drive markets. Price is the foundation of all technical analysis. This is essentially the raw material that every other tool is built off of. So whether, again, we're looking at a candlestick chart, a line chart, a bar chart, and we're going to look at all of these types of charts today and discuss how they work, why people use them, and why I ultimately settle with using the candlestick chart. But at the end of the day, nothing else truly matters. So something to remember is price is essentially just the agreement point between a buyer and a seller. Every time there is the volume goes up by 1, there are at least 2 market participants, a buyer and a seller. Price is not a value. Price is not a prediction. Price is merely an auction. This is the point where a transaction between a buyer and a seller was had. Every single point on this chart represents one of those locations. So every tick that we go up, down, or stay the same, this is a micro vote on what the market currently thinks the asset or basket of assets is worth. So price, again, is the culmination of all of the current supply and demand in the market at that given instance. Let's talk about how you interpret and look at price itself. Each of these, as you know or should know, is called a candlestick. It represents a specific unit of time, in this case, 1 minute, and we're going to cover more on time in just a little bit. But for now, each of these candles represents 60 seconds of price action that we saw today for the NASDAQ QQQ ETF. Now, there are 3 types of candles. There's subcategories as well, and those will be dived into in briefly both in this lecture and a future lecture. I believe it's the 4th lecture in this series, which covers all of the major candlestick patterns. But for now, the 3 main types of candlesticks we are going to look at are green candles, red candles, and doji candles. Let's start with a green candle. We can find a good example to look at. Separate this as wide as possible. Let's take this candle right here. So a green candle. For every candle, there are 4 points: the open, the close, the high, and the low. Okay? There are two main components of each candlestick: what we call the body, which is the filled in section here, and the wicks, the skinny lines to the top and the bottom. Not every candle has a body, and not every candle has a wick. Here's an example of a candle with no body. We call those dojis. And there's several examples of candles without bottom or top wicks, but sometimes you will see candles without either. Now, how to interpret this? Green candles. These are bullish candles. So the body represents the open and close price. On a green candle, the open is the bottom of the body, whereas the close is the top of the body. Or on our example candle, we see here the open, where the candle opened at the start, beginning of its existence, was at the bottom of the candle, and or at the bottom of the body. The close of the body is where price closed after 1 minute. The wick represents where price fluctuated throughout that 1 minute or whatever time frame you're looking at. So for this candle here, we see we opened here, had some combination of price action down to here, price action up to here, before ultimately settling here. So what this tells us is this candle shows all of the different points that price went and ultimately where it opened and closed at. And despite that, there's even more information in each candle as you dive into further and further time frames, because price wasn't, went here, then instantly here, then instantly here, then here. Each candle tells a story. And now these are 1 minute candles, so they are very small, but you could even, if you wanted to, go into 10-second candles and see exactly how this formation happened. Or if you want to zoom out, for example, and look at a daily candle. This is the candlestick right here for today. And everything that you were just looking at took place within this larger candle. So essentially, every candle is within another larger candle. And in theory, that goes however you want, infinitely in both directions. Now, back to where we were. Another quick tool is on Thinkorswim, you can click to zoom in. And if you zoom in too far, like this, you can right-click the black screen and auto-zoom back to where you were. Or there's a couple other options. You can also use the bottom to move price left and right, and the top to move price up and down, or to stretch price left and right and up and down. May be best if I use the grab tool. There we go. Okay. Next, we're going to talk about red candles. The main thing to know about green candles is a green candle closes higher than it opened, thus it is green. Red candles are the opposite, as you've probably inferred. A red candle, I want to find a good looking example of a red candle. Here's one. Right here. A red candle opens at the top of the body and then closes at the bottom. So when you look at candles, you have to know, based on the color, green or red, where it opened. Green candles open at the bottom of the body and finished higher. Red candles opened at the top of the body and finished lower. A candle like this, for example, is a candle with a very long upper wick, meaning price opened at the bottom of this candle, saw a massive move to the upside, rejected, still closed higher, but a lot lower than where it was before. The last candle type and the rarest candle type, just by looking at this chart, is the doji. The reason I chose the 1 minute chart is because the 1 minute chart will have more dojis than any other time frame. And you'll understand why in a second. A doji is a candle here. It is often portrayed as a gray candle. I see a couple just on the screen here. Here here, here, here. If you were to go to the daily chart, you would see essentially 0 dojis. The reason is that the body is non-existent. This means that the price opened and closed at the exact same price to the very cent. So even though we fluctuated, went higher, went lower in some order, we ultimately closed exactly to the cent where we started. And on something like QQQ, that trades for $560.27, it is very rare we end up on the exact same cent. That's a lot of cents of variation. And the further you go out, the less dojis you're going to see, as more time provides more opportunity for variation, and more variation provides less of a chance we end exactly where we started. Dojis are fairly rare, but on small time frames like this, they are less rare. For the sake of this lecture, we're going to talk about dojis a little bit, but not very much, as there is some things to look at. Obviously, you do see variation in price, but overall, dojis are closing exactly where they opened, basically saying, in this time period, price made no change. Now that we have explained the basics of candlesticks, how they open, close, and how to read them, we are going to zoom out to the daily chart for this next portion. In this portion, we are going to visualize the other types of price measurement. Candlesticks are very often used by, I would be willing to bet over 95% of traders use candlesticks, but they are not the only type of way you can measure price. We're next going to look at bars. Bars are probably what I would say is the second most popular on a platform like Thinkorswim, maybe the third most popular after a line chart. If you're considering things, if you've ever typed in a ticker into Google, you've seen what we call a line chart, or if you're on Robinhood, Webull, some of those platforms do default use line charts, which we will show as well. But bar charts are what I would consider to be the second most common way to measure price. The reason that they are popular is because they are very discreet, a lot less noise going on. But regardless, they operate almost identically to candles. It is more or less a visual decision to use a bar. For example, as you can see, rather than having a body, bars have a left line, a right line, and a middle line. So the difference here is price always opens at the line on the left, closes at the line on the right, and the middle line is the variation. So if you struggle sometimes to remember that green candles start at the bottom of the body and at the top, and red candles start at the top of the body and end at the bottom, you can simply use a bar chart, as it's easy. The left shows where price opened, the right shows where price closed. Other than that, not a whole lot of advantage to using bars. I do think they look very clean, and I've used them before for the sake of what I do, where I post charts and do technical analysis for others on live streams and other means. I do very much like having candles, as I feel like they visualize more. These take a little bit more thinking sometimes from a distance to actually understand what is going on. Okay, the next one that we are going to look at is the line chart. This is quite a bit different, a lot less noise here, very straight to the point. But the line chart simply takes the closing price at the end of the period. So on the daily chart like we're looking at here, every point on this chart is showing what the price closed at. You're going to see these types of charts if you go on Google and just search a ticker, you'll see it. If you're on Robinhood, by default, you'll see a line chart, etc. Very basic. It gets rid of a lot of the noise for those who just simply want to see the long-term trend or short-term trend, whatever you're looking for. But other than seeing a final price, there is very little information that is made available. Now, another similar, we'll do this in the same little segment here, the area chart. Now, the area chart is the line chart with the bottom filled in. So, again, provides very little difference, but some people do prefer the area chart simply for the way that it looks. And it is, again, mostly designed for simply looking at the trend, nothing more. Very little detail on the price action itself is made clear with these charts. Next, we have the heiken ashi candlesticks. These are a very interesting candlestick usage, and they serve their purpose. Not recommended to trade this consistently, but it is best used for looking at the overall trend. Now, the way the heiken ashi candle works is it is simply taking average prices over a time period, so you're able to more clearly see the actual trend itself. Obviously, you could come up with some strategy that goes short when the candle turns red and goes long when the candle turns green. It's not perfect. You can see some false signals. But what this is doing is it is taking the average value of the candle rather than simply the open, close, high, low. And because of this, you can see a lot less wick and a lot more body on these candles. So I very seldom use heiken ashi. I'll maybe take a look at it if I want an overview of potential trend, but that's about it. And there are some fake outs. So usually if you are using this as a signal to go long or short, you need to see some confirmation, right? I wouldn't take a trade in either direction unless you see 2 or 3 candles of the same color in a row. But if you had played that for the most part of this year, we've had some very large dramatic trends on the way down and then back on the way up. You could have made a lot of money simply looking at the heiken ashi chart. But again, you're not getting the full story because it's smoothing the data out. So again, I don't recommend using this as a primary strategy, more so as confirmation of your existing strategy. Now, the last major price tool in terms of looking at the price that we're going to look at today is the equivolume. This is one that I don't think I've ever used once, but just going to share it here for the sake of sharing it. This combines volume and price and essentially is showing how much volume we saw on specific candles. So the up and down vertical size of the candle is going to be similar to the real value, but the thickness of these candles is representative of the volume on that day. So you look at, again, this day on April 9th, one of the most bullish green, best days for the stock market ever. Volume was tremendous, and this candle was very, very thick. Then you look at some of these other candles, very, very thin. So if you're looking for a volume confirmation, this may work, but at the same time, you might as well just have the volume displayed at the bottom and be able to differentiate using your own technical analysis. This makes it a little complicated to see actual prices, so do not recommend using equivolume. There are some other types as well, like the monkey bars. But the monkey bars are a very advanced strategy or view of price, and I'm not going to be sharing them here. I may share those later down the line in a later course, as I have not particularly used them very much, but that will be shared as well. Now, why did I share those with you? I think the main reason that I did is to show that you don't just have to look at candlesticks if they are not for you. I'm sure there are plenty of people who use the other types of charting and are able to be consistently profitable. The main thing, though, is use them to your advantage. If you want some confirmation, on trend continuation, maybe take a look at heiken ashi. If you want to completely ignore the intraday battle between buyers and sellers and just see where price is closing, again, the line chart would work very good for that. But then a candlestick chart, I don't think you can beat it. You can see indecision the best. You get the best representation of overall price. Now, something to cover. Price very rarely respects a single line. This is why the line chart is difficult, and I prefer not to use it. Price respects zones, right? We have a full lecture that will be dedicated to support and resistance. I believe that may be the next lecture in this module. But zones are where price tends to congest around, not a specific exact to the cent point. So the reason that this occurs is because orders are done in an auction setting where there's a buyer and a seller and they meet in the middle. Oftentimes there's a little bit of a spread, so buyers and sellers, you may be filled for 100 positions of a share at at 100 different prices in the same zone. So orders stack up in zones and not just in specific price. So a good example, I guess, might be you go on this chart, say you're looking here on QQQ at about the 540s level, where we obviously saw some resistance in this zone here, right? Now, if you were to have just been going off of explicit price off the prior high at about 539.24, you would have realized price went up to 540.86, about $1 above that. So, the former resistance at, say, 539, what did we say? 539.24, say, maybe a zone between maybe 530 and 541, right? Especially if the volume clustered in this region. Institutions do not care about your exact line. They care about fill zones. So that's something to get through your head, especially the technical purists. Prices, specific prices, are not the best way to chart support and resistance. Zones are. Every single time that price pauses, reverses, breaks out, or even consolidates like this, it leaves behind structures that traders will watch in the future. Those structures include some things like highs and lows, say highs and lows, ranges per se, trend lines, which I don't have one drawn here, breakout levels, right? The prior all-time high was a breakout level. Once we broke above, we continued higher. Gaps, another big thing I like to chart. These all become reference points for the future. So when charting, you are only looking at past price, right? That's why sometimes at all-time highs where we essentially are, it can be very hard to chart because we've never been here before. During this recent recovery from Tariff Trade War 2.0, we crashed starting at the end of February before bottoming out on April 7th. We had a lot of really good levels to look at because price made a lot of movement. So as we went higher, we were able to see some very critical points and plan accordingly. Here's an example. We had a relative high at this price point here. This was a good example of a prior resistance level, and a lot of the psychology at the time was if we were to break this level here, we would continue higher. And funny enough, we did exactly that. We gapped above it tremendously, showing that the buyers were waiting to get above this level to kick in. And after that level, we went much, much higher. We didn't reverse, none of that. We went right up. Now, another thing to remember, price reacts to absolutely everything. Even if it's minor, price is reacting to everything, especially on something like QQQ. If you're trading the indices, SPY, QQQ, DIA, any of these, price is reacting to absolutely everything. Every macro event, every tweet, price upgrade or downgrade, CPI release, or maybe a Fed speech, it all shows up in price. Not always the way that we expect or would like, but it always shows up in price. The best way to look at price is to look at it like a journal of trader psychology. What you're seeing here is the past 12 or so months of daily chart price action for QQQ. This is every single day is leaving a fingerprint in the market for future reference. we can see what trader psychology was every single day over the last year. Again, it is not necessarily the news that matters in the end. It really is how price reacts to the news, and it often reacts differently than how we would expect. But price is truly the source of all technical analysis. Everything is built off price. It is the only thing other than time that is absolute, right? RSI, that's based on price. MACD, moving averages of price. VWAP, that's price plus volume. Bollinger Bands, even, that's a standard deviation of the price. So the indicators are very helpful, but they are simply derivatives of something else, and that is price. They often and always tend to lag while price is real. So there is a sizable percentage of traders who are simply naked chart traders, as we like to call them, but they only use price and levels alone. And that is a viable strategy. I have several strategies that I like to use at different points that simply use price and price alone. And we're going to talk about all of those in this module. Now, you can learn a lot just from candlesticks and price by itself. We do have a full candlestick lecture in this module that breaks down most, if not all, of the major candlestick patterns that traders use and should be aware of. But just a quick little recap, or not recap, a little briefing on this psychology. Every candlestick, like we said, tells a story of who won the battle in that time frame. So if you see a long wick at the top, say this candle, this shows the buyers lost. Despite being a green candle, they lost to some extent. Buyers bought up, and at the end of the day, they were not able to hold the highs and were sold off near the end of the day, which is what this candle looks like. And obviously, we can see that continue to play out. I would have bet that there was end of day weakness here, and we sold off tremendously after Liberation Day. Then the opposite is true. If there's a long wick at the bottom, that means the sellers lost. A couple examples we see here. I'm sure there's a couple more I'm seeing here. This shows that sellers brought price down, but the end of the day, or the end of the period, or maybe even the last section of the period, the buyers bought it back up close to where the sellers started, and we often see these trends continue. We see the same thing here. Another thing to look at is a full body, right? When you see a full body with very little wick, that means that the buyers or the sellers, whatever the candle is, were in full control the entire day, right? There was no losing for the sellers. There was no winning for the buyers on these candles. And last, we have small bodies. This shows indecision. When you see small bodies and a big wick like this candle here, this shows buyers nor sellers won. And the next day's price action was more or less a mystery, as we don't know or didn't know what was going to happen, as this day was essentially a wash. Buyers won a little bit, then sellers won a little bit, or in some order. Ultimately, we finished right about where we started. So, quick little recap from everything we talked about with price. Again, price equals an auction. This is not, again, anything more simple than that. It is an auction, and an auction alone. It is the last agreed value between a buyer and a seller. Different chart types, like we looked at with line charts, heiken, ashi, etc., they very much change how we perceive the same price data, even though the data ultimately is the same. The price structure that we see over time leaves memory, and traders use this in the future to trade correctly or to find levels. Zones are more important than precise levels. Liquidity concentrates in areas, not at specific points. It never has, nor will it ever. Indicators are all simply derivatives of price, right? Price is the only thing that is absolute. They are simply portraying that price or using the price that exists to tell some kind of other story. And candlesticks are essentially stories of control, reversals, and momentum. This is everything I believe is the basics to know about price. until we have further lectures on candlesticks, support, and resistance. Now let's dive into talking about time. All right, let's now talk about the other dimension of charting. We talked about price in depth. We are now going to talk about time. Time is just as important as the price. To a different extent, obviously price is absolute and time is absolute. Price is what makes you money, right? You don't necessarily care about the time unless you're trading in something that is time dependent like options or futures, but it is still very important for technical analysis itself. So if price is what's telling you what happened, time is telling you when and for how long these things happened. So time is really the broader context that transforms the raw price movement into meaningful structure, right? Without that time, you can not have any trend, and without a trend, you have no edge trading. Time is truly a dimension that you can and should be trading. So every trader, regardless of their skill level or experience, whatever, or their style of trading, is seeing the market a little bit differently. And it's not necessarily because they disagree on price. The biggest difference is that they are viewing it on a different time horizon. So a 5-minute chart, for example, might look a little bearish, but the daily chart could still be in a strong uptrend. So this is time frame relativity. And this explains, in essence, that a short seller and a long-term investor can both be right about the same stock. They may just have different outlooks and time horizons about what they're looking for. So the shorter the time frame goes, usually the more likely you are to see retail get chopped up by institutions who are playing and waiting for larger setups. So let's talk about some of the most common time frames and where they default to. The most common time frames you're going to see is if you just come up to the time frame, you are already going to see what are regarded as the major time frames, right? If we start at the 1-minute chart, what you're going to see here is a lot of noise, right? The trend is not necessarily clear, as anything can happen minute to minute. Lots of movement. So the 1-minute time frame is not particularly great for any specific type of trading, as there is just so much movement. But if you are using it for entries and exits, which I'll talk about in a second, probably best for scalping, tape reading, and very hyper short-term quick trades, right? My favorite time frame to trade intraday is the 5-minute, as you get the perfect balance of candles while also having the broader trend fairly clear. All right, again, this is best for intraday setups without losing too much information to the lack of candles, right? 5-minute chart is, in my opinion, the best to be using for actively scalping and day trading. Then we have the 15 and 30-minute charts. The only issue with these charts is the lack of data or the lack of data points, right? So each individual candle is useful for what we're going to talk about later, but a 15-minute chart only has, what is that? Would that be 26 candles? That's not a lot to get a lot of price action on. So you're kind of teetering on the border of, losing the day trading ability with the 15-minute and pushing more on swinging or slightly longer setups. And the same goes for the 30-minute time frame, right? Not a lot of candlesticks to look at here at all. But what these are best for is if you're looking for an opening range trade, which is a really popular strategy I like to use as well, these are the time frames you're going to be looking at. Then we have the hour chart, which I don't like for a couple of reasons. The biggest reason being, if you're using it to day trade, it's useless in a lot of ways, mostly because you're not getting enough data points. But the major reason I would say that I don't like the hour chart is because it is lying to you just ever so slightly, with the biggest reason being each candle is not made equally. And the reason for that is that the stock market is open for 6.5 hours per day. So because of that, the first 6 candles have an hour time frame, while the last candle has just 30 minutes, as the market's only open 6 hours and 30 minutes. So how I rectify this and use a specific time frame that I like to use best for swing trading, I use the 65-minute chart. You can use the 65-minute chart by going to time frame and typing in 1 hour and 5 minutes, which you can simply do here. Okay? And this gives you 6 identical candles representing each day. Now, the biggest complaint people make is that 65 minutes seems to be a random time frame, and it is, but the message is that the time itself doesn't really matter. It's essentially showing 6 equal candles that are roughly 1 hour of the day each. So the 65-minute chart is used by a lot of more advanced traders for swing trading in particular. Next, we have the daily chart. Another, probably my all-time favorite chart to chart on. That's probably the most popular answer to this. This is showing you, in its essence, 1 day's worth of price for each candle. So for longer term setups, buying and selling stocks, the daily chart is your best bet. You're not going to beat this. Okay. Then you have the weekly chart. Similar to the daily, but a lot less candles overall, right? There's only 52 weeks in a year. So you're getting less candles, and some candles lie to you here as well, for the main reason being some weeks are shorter due to federal holidays. Some are a lot shorter due to federal holidays, and this creates some small imbalances with candles being maybe 3.5 to 4 days in length. But overall, the weekly chart is giving you the long-term analysis, cutting out a lot of that noise. And the last major chart I would ever use really is the monthly chart. Now, the monthly chart, as is obvious, is each candle is showing a month. The reason this is important is because you can see the overall time frame in the long term very, very clearly, right? We're now on month 5 of this uptrend. We've had 5 green candles in a row to this point. There's good analysis to be looked at here. But the rule of thumb is that the higher the time frame, the stronger the signal becomes. And the lower the time frame, the more noise you're going to see and the weaker overall the signal will be. Okay? So if you're getting a buy signal on the daily time frame with a certain indicator and getting one on the 5-minute time frame with the same indicator, the daily time frame signal is going to be stronger. And that's why you definitely want to be using multi-time frame analysis. Now what that is when multiple time frames agree with the same setup. So some example of this may be SPY is breaking out to the upside on the 5-minute chart and is also potentially confirming a bull flag on the daily chart, right? This is what we like to call time frame confluence. And this is when we're seeing multiple time frames showing the same overall signal to the upside or downside. And this will give you a slight edge compared to traders who don't use this. So professional traders or most profitable traders use some type of time frame, multi-time frame analysis. And there's 2 major types of multi-time frame analysis. There's the top-down analysis and the bottom-up analysis. So a top-down analysis would be looking at a longer time frame like the daily chart and identifying the trend, right? So say in this instance, the long-term trend is bullish, right? And then zooming in to say the 5-minute, 15-minute chart, whatever, and then only taking bullish trades that appear or signals that appear on the smaller time frame. So you're trading the longer time frame inside in a smaller time frame. Then there is the bottom up analysis. This is the opposite. This is where you're using maybe the 1 or 5-minute chart to nail a precise entry inside of a larger time frame. So maybe you're trying to buy a stock and you're trying to time your buy of the stock to a good buy signal entry in a shorter time frame. Both are good strategies. I prefer the top-down analysis. That is more or less how I trade short-term positions, scalps, day trades, etc. So the other thing to consider and remember is that trends only exist with time. Okay, a single price spike or dump is essentially meaningless without some type of time. So to define a trend, you need at least 2 or more price points over time. But the real trends emerge really from a couple of different things, which we are going to go dive deeper in further lectures a lot more in depth. But these include higher highs, right? So in an uptrend, you want to be seeing higher highs and higher lows, right? So in this most recent uptrend, we were consistently seeing higher highs and higher lows, okay? This is a bullish uptrend. And on this most recent downtrend, you saw lower highs and lower lows. It is often when this is broken that the trend begins to shift. Okay? The last thing to consider as well is the third option of consolidation. So, in an instance where you're seeing equal highs and sometimes equal lows, that is a signal of consolidation and potential market indifference, and you often will want to wait for the breakdown of either the highs or the lows to take a position. In this case, we saw a breakdown of the lows, and obviously we continued further down. All right, so the duration of these trends matter. On the daily chart, these trends are going to give a lot better signals than an uptrend or downtrend on the 1 minute chart. All right, so a breakout on the 1 minute chart could last 3 minutes. Still enough to make profit if that's the time frame you trade, but a breakdown on or a breakout on the daily chart or weekly chart, I mean, that might start a 6-month rally, right? So the idea is the same, but the longer the time frame, larger the time frame is, the more likely your position is to be, or the more likely the trend is to be reliable. All right, so time can also tell you when a signal is weak or strong. So for those who don't know what, say, the RSI indicator is, we will be touching a lot more on specific indicators further into the series. But the RSI is the relative strength index. And let's say the relative strength index hits a signal of 80. And for those who don't know, that is a massive overbought signal. So on the 1 minute chart, a reading of 80 really means nothing. It is mostly noise and very well could reverse in 3 candles, right? Whereas the daily chart, when the RSI is at 80, that shows there is big money momentum on this time frame, and we could see the price action remaining overbought for days or weeks. So don't treat all technical indicators signals the same. The time frame controls the signal power. Remember this. So the lower the time frame is, the more noise you're going to see, the more random volume bursts you're going to see, and emotional trades. Higher time frames naturally filter this noise in the long term. And the way that I like to trade if I am going to be day trading or scalping is I'm identifying the direction of the overall trend on the daily chart. I am then trading a setup on the 5 minute chart, and then I'm exiting or entering risk on the 1 minute chart for precise entry, as that does improve profits in the long term. Let's now do a quick little recap of everything we talked about in the time frame or the time section of this lecture. So time frames shape your perception of the market. As the same stock or ETF might look completely different on 2 different time frames. So a bearish and bullish trader on the same ticker can both be right because of their time horizon for the trade. So the trend, they need time to form. So the higher the time frame is, the stronger and more reliable this trend will be. And again, time frame confluence, this is when multiple time frames are agreeing with the same overall setup. Signal strength, right? These are when indicators are going to be more reliable depending on how long the time frame is. An overbought or an RSI divergence is going to be more reliable on the weekly chart than it is going to be on the 1 hour chart. And yeah, these higher time frames filter out the noise naturally and cut through the chop and get right to the bigger picture. Lastly, certain times of the day are going to have more meaningful price action. The first 30 minutes and last 30 minutes of the day are more meaningful times than the middle several hours. So because of that, different candles are going to have different values and meanings, even though they are represented equally. We will be going a lot more into a lot of these things in further lectures. This is a brief overview of how time is important for trading. That should cover mostly that section. We have now discussed the difference between price and time and the basics of both. We're now going to dive into the four major forms of technical analysis and how all four of them should be used in combination for finding good or perfect setups. So, trend is the backbone of all price movement. And if you know the trend, you know the path of least resistance. What most traders don't realize is that trends are substantially more likely to continue in their current direction than they are to reverse directions. So if you simply play the current direction of the market price action in any time frame, you are more likely to be correct than you will be if you were to try to play a reversal. So again, trading in the direction of the current trend will dramatically increase your odds, but only if you know how to define it. So the old saying is, the trend is your friend until it ends. So a trend in its simplest form is the direction that price is moving over time. And there are only three possibilities. Uptrends, again, higher highs, higher lows. Downtrends, lower highs, lower lows, and sideways consolidation with no defined trend. So the main goal of trend analysis is not to predict the trend, but it is to align with the current trend and know when they're likely to continue and when they're likely to pause or reverse. So let's dive into a little bit more about the structure of the trends and when to know when you should not be playing the trend any longer. Let's start with a great example of a solid long-term uptrend. We're going to go back in time a little bit to October of 2022. The stock market had been in a bear market downtrend for quite some time, and we ultimately bottomed on October 13th of 2022 before starting what has now been a multi-year uptrend. So the best way that we can define that this is a solid uptrend is obviously the highs are gradually getting higher and the lows are gradually getting higher as well. You can see here there's a few exceptions for slightly lower lows, and those were temporary breaches of the uptrend. But overall, we're seeing long-term that the major lows were lower or were going higher, higher, and higher. I use this red line to show exactly what I mean. Now, we did see a major breach below the long-term trend line due to not a black swan event per se, but a change in sentiment due to the tariffs and what they could potentially have implicated in the first chunk of 2025. But we did again regain the long-term uptrend. So in uptrends like this, dips are buying opportunities. When we are in a cyclical uptrend, you want to be looking for a retest of the trend line, like I have drawn here. And when price does retest this line, you can expect it is more likely that we will bounce and continue higher than we are to break down below it. So obviously there's been some examples where we did break below because of rare events. But in essence, we have seen consistent price movement to the upside. Trends slope upwards, and institutions, individuals, funds, CTAs are accumulating during this phase. This is a great example of an amazing strong uptrend. If you would have bought at essentially any point on this uptrend, literally any point on this uptrend, you would be up, as we did recently make a new high on the most recent day. We also have the opposite, and that is downtrends. Something I'll mention about downtrends: downtrends historically are a lot shorter than uptrends. The way that the stock market is designed, at least for the indices, it is different for individual stocks, but the indices like QQQ, you will see that the downtrends tend to be much shorter than the uptrends. And there's a lot of fundamental reasons as to why that is the case. But just remember that this is not a universal truth for all tickers, simply for the indices. So, if we're going to analyze this a little bit, we can see starting at the end of 2021, at least for the Qs, going into October of 2022, we were in a major downtrend. And this is, again, easily identifiable by lower highs, 1, 2, 3, 4, 5, and lower lows, 1, 2, 3, 4, 5. Okay? So rallies in bearish downtrends get sold. So you would have been best during this downtrend to have been selling whenever we had seen a retest of the trend line. You could get a pretty good idea. You know, it's not, again, charting is not always perfect. You're not always going to see exact trend lines perfectly, but overall you can see that the trend was clear. It lasted about 11 months for the Qs and about 10 months for the S&P 500. You also see some distribution where you will see some consolidation while the market is deciding which direction to go. Now, the time that you should start going against the trend is when the trend has broken. So as you can see here, we had a solid downtrend of lower highs consistently over the course of a year before we eventually, starting, really the bottom was in October, but the trend was still in a relative downtrend with lower highs until we broke this level in early 2023. Price broke above this trend, and now instead of lower highs and lower lows, we saw a higher low and a higher high. So in a downtrend, once you see a higher low and a higher high, the trend has changed. The same goes for bull markets. Once you have seen a lower high, which we saw in a very minor downtrend in April, May, June, with lower highs, lower lows, that is a signal the trend has changed. Now, this is a really rare example, as this trend, this small downtrend, reversed quite quickly due to the fact that the fundamentals changed in the market. It wasn't necessarily a technical downtrend, it was more of a panic selling off of the fears of tariffs. And once those fears alleviated, and we saw a couple of other things like the signing of the big beautiful bill, which was a very bullish bill for equities, we saw the trend continue on its uptrend, and now the trend line is very similar to where we were. So we can even zoom in on this smaller trend and see we had consistent lower highs, lower lows in the downtrend before we saw higher lows and higher highs in the uptrend. So the question was, if you were playing this downtrend, at which point should you have considered that the trend had changed? Well, the point here was fairly clear. This was a very clear downtrend line, and we saw price break above it pretty quickly after it started in late April. Once we broke above this trend line, the trend had changed and we were looking to be in an uptrend. We saw some higher highs here and higher lows there. The trend had changed. Now, there's also one last thing that we've discussed, and that is the third possibility of consolidation. So, consolidation is neither. Consolidation is a period where rather than seeing higher highs and higher lows, you see a combination of higher lows, higher highs, lower highs. But essentially, price action is staying very much in a range. We saw the same highs not being breached, right? That's the highs remained the same. The lows got a little bit lower, but in essence remained in the general range. So in consolidation, you see range-bound price action, fairly equal highs, equal lows, and they very often precede big moves, especially on the longer time frames like the daily chart for an indice like the QQ or an index like QQQ, SPY, DIA, etc. Okay, I have always said and taught it this way that it is like a spring. Price action always wants to be trend bound in some direction. The longer that you see price consolidating in a range, you have to think of it like a spring that wants to break in one direction. All right, so the longer you consolidate on a long time frame for a major index, the more likely you're going to see a massive move. That is exactly what we saw. We saw a major uptrend for several years, and then we stalled out with some major consolidation that lasted several months before we ultimately had a massive meltdown in equities. And to measure exactly what that meltdown was, roughly for the Qs, it was about a 25% collapse. There was a lot of money to be made to the downside and then subsequently to the upside. And you could have seen that a large move was coming based off of this longer term consolidation. So, what are the best tools to identify trend? Now, there's no necessarily consensus right, correct, best way to identify trend, but we have a multitude of tools, especially in Thinkorswim, that can allow us, with practice and knowledge, to identify trends. The first being structured, like we had mentioned, the higher highs, higher lows, lower highs, lower lows, or equal highs, equal lows for consolidation. That's one of the best ways to do it. So price action itself can be good for identifying trends. You can see if there's clear directional movement. We also talk about trend lines and channels. We're going to go into a full lecture later in this module where we very much break down how to draw trend lines precisely and the best way to use them. A whole drawing tools lecture, so we won't go too much into the detail here. But that is a very useful tool as well. The other tool we're going to briefly discuss today is our moving averages. Moving averages can very clearly show you the trend as well. So what I have here are two simple moving averages, which we again will go into further detail in the trend dedicated lecture itself. But what we see here are moving averages that take the average price of the last X amount of periods. So these are simple moving averages. And I have one that is a 50 period moving average and a 200 period moving average. So this quicker, more volatile moving average is the 50. This slower is what we call the 200. Each of these is taking the average price of the last X amount of periods. So this is taking the average candle price for the last 50 periods, and this is for taking it for 200. So the difference and advantage between using these are with a 50 period moving average is you can say if price is below this moving average, that means the trend in the relatively medium term is in a downtrend. Versus when we break above this line, this dynamic moving average, price is in a relative uptrend. And you can see we lined up very well on the 50 with the uptrend, right? The trend line said the uptrend started about here. The 50 period moving average said it started about here. Both are solid tools to identify the trend. The 200 is a little bit different. It's a little bit of a slower moving average because it's taking more periods into account. So according to the 50, the downtrend started here on February 24th, which was spot on, whereas it didn't start for the 200 until it broke below on March 6th, right? So the advantage to the 200 is that it's going to be more reliable in terms of the long-term trend because it's getting more data, but it's also going to be slower to react to things like this. So you also will see these two major moving averages in particular acting as dynamic support and resistance, especially the 200. You can see we broke below the 200, and then we did ultimately reject off of the 200 as some resistance here and here. And then we did see the 50 acting as some sort of resistance here as well. Now, with the 50 and 200, there's also something that we like to call the golden cross or the death cross. I don't necessarily fully believe in this style of technical analysis, but just to explain what it is, this occurs when the 50 crosses below the 200. This is a death cross, and a golden cross occurs when the 50 crosses above the 200. So historically, and this is a really bad example for a death cross because, I mean, the death cross happened after price had already bottomed out. Historically, when you see a death cross of the 50 crossing below the 200, that is a bearish signal over the coming period. Whereas the opposite is true for the golden cross. Once you see a cross for the 50 simple moving average above the 200, that is very bullish for the coming period. Again, this was a very bad example here for the death cross, but this looks to be a great example for the golden cross. Now, that is just an example. There's going to be a lot more that we're going to cover in the trend dedicated lecture itself. But to sort of speed things along, we're going to just talk about a couple of terms to know. The first being continuation, right? This was a long-term trend as designated by this long-term trend line. Continuation would be defined as a bounce here off of the trend line before continuing in the initial direction. So when you're pulling back to support, like we're seeing here, and then bouncing, this is what we define as continuation, right? Also, continuation is defined by breaking out of a recent high. So when you're making higher highs or lower highs if you're talking about a downtrend continuation. And then consolidation followed by range expansion, like we see here. This is continuation. The other term is reversal. This is failure to make new highs or lows, depending on the trend, and a break of the trend or a very structural shift. So the example of a reversal would have been here, where we retested the trend and we even attempted to get back above it briefly before reversing back below the trend. This was not continuation, this was what we call a reversal, as the trend was temporarily, in this case, disrupted. Now, we could have just as likely made continuous lower highs and lower lows in this trend, but we did happen to break back above. And this is actually unusual. It is something we have seen in recent years where we've seen these V-shaped recoveries, but historically the stock market has longer bearish trends than this. This is a more recent relative occurrence. But ultimately, this is what we are going to be calling a bear trap. The reason it's called a bear trap is because we reversed. We did not continue here. The trend was disrupted, and every signal here pointed to a bearish continuation from a technical perspective. So the bears got sucked in and started heavily shorting on this trend because the technicals appeared that we were going lower before ultimately massively reversing higher, thus trapping the bears and hurting anyone who was doing trend analysis if they continue to short even after we broke back above this relative trend line. So the market cycles through 4 phases of trend overall, and it's not always a fine, hard rule, but this is more or less what we look for. We look for accumulation, which we saw here. Accumulation is a sideways movement after a downtrend. So you can usually tell to some extent when a downtrend is coming to its end because you will see accumulation where price is again making pretty similar lows, pretty similar highs after a major downtrend. We then have the markup phase. This is where the trend begins of higher highs, higher lows, higher highs, higher lows. okay? And the market phase tends to be the longest phase of the cycle. Next, we have the distribution phase. This is similar to the accumulation phase, but after an uptrend, right? It's where you see a topping process taking place, slowing momentum, and price moving sideways for just a bit. And then we have the markdown phase. It's where we see a breakdown of price, lower highs, lower lows in the price. Very useful for understanding long-term trends, and especially in the indexes, you will see this process happen over and over and over again. Now, something else to consider is that trends exist within trends. Okay, as you're seeing here, overall, we've seen consistent uptrends and downtrends, but in each uptrend and downtrend, you're seeing smaller trends. So here, we're in the midst of a major uptrend, yet we saw a minor downtrend where we saw lower highs, lower lows, before ultimately continuing the trend. So a daily uptrend could potentially include a 5-minute downtrend, or a weekly downtrend could potentially include some daily bull flags. So multi-time frame analysis is critical when doing trend analysis. Trends are also not all created equal, as is made clear by this sort of signal here. So you want to ask yourself, is the trend steep, gradual, etc.? Are pullbacks shallow and controlled, or are we seeing deep and very erratic pullbacks like we've seen here, etc.? And last, are we seeing breakouts followed by volume and continuation? All important things to consider when doing trend analysis. All of these things will be touched a lot more in depth in the trend analysis lecture that will be coming shortly. So here's some quick tools to measure trend. Obviously, we talked about the trend lines and channels, volume, right? Healthy trends often see increases in volume as the trend gets stronger and stronger. Another tool to measure trend strength is the ADX, right? This is the average directional index, an index we're going to go into a much more detailed analysis later on. But this measures trend strength, and signals above 2025 give you a good measure of trends, that the trend is overall strong. So all of these will be touched on in this coming lecture, and I'm very excited to do that. I love trend trading. It is my favorite type of trading. But there's also a lot of misconceptions in trend trading. So fighting the trend because it's gone too far is a common mistake. Again, the trend is a lot more likely to continue than it is to reverse. Buying dips without confirming structure is another major no-no in trend trading, as again, the trend is likely to continue, more likely to continue than it is to reverse. Another one is selling too early because price feels overbought. All right, that has been a major thing over the last couple of years of uptrend. And confusing consolidation with a reversal pattern, right? Sometimes it does lead to a reversal pattern, but a lot of the times it does not. An example would be here, where we consolidated for weeks and weeks, reversed slightly, but then dramatically went higher. So consolidation does not always equal reversal. And a strong trend can stay extended far longer than most expect. We've been in the midst of a major multi-year uptrend. A lot of people thought we would have reversed by now, and we've continued to make all-time highs every couple of weeks. And being overbought is not a sell signal, it is a sign of strength. And the same goes for a downtrend. An oversold indicator does not always mean that it's a buy signal, as a very strong oversold signal can mean strength as well in a downtrend. So some recaps here. Trend equals direction, right? An uptrend, downtrend, or sideways structure does matter, and you want to be trading the overall trend. Higher highs, higher lows, lower highs, lower lows, these are healthy trends you want to use to your advantage. A continuation versus a reversal, again, know what phase of this cycle that you're in. Use multi-time frame analysis to confirm the trend in multiple time frames, and use different strength indicators like the ADX, slope, or volume to confirm the overall trend strength. Now, some examples of trend indicators that will be touched on in the trend lecture. We're going to go over the EMAs. We touched on the SMAs briefly today, the VWAP, the anchored VWAP, the Ichimoku Cloud, parabolic SAR, again, the ADX, crossovers like the golden and death crosses, multi-time frame analysis, the Williams alligator, super trends, Donchian channels, linear regression channels, etc. We're going to touch on all of this. Now let's move on to momentum trading. All right, next we are going to be talking about momentum, right? Momentum is the second major type of technical analysis that we're going to be analyzing here. And momentum is essentially just telling us how fast price is moving and really whether that price is accelerating, decelerating, or running on fumes. So if trend is telling you where, momentum is telling you how hard it is going. Momentum and trend are very useful tools to use in combination with each other because you can use momentum indicators and strategies to identify if a trend is more or less likely to continue in the direction that it's going. So again, momentum can help you identify if a breakout is likely to continue going higher, or if the move is losing steam, or a reversal is more likely. Reminder, technical analysis is not absolute. It is a game of probabilities. So you want to use as many different indicators as you can, or strategies as you can, to identify and give yourself the best probabilities of success. Because even getting a perfect signal does not always mean that it is going to be right. It is giving you a probability that you are more likely to be right. The main question is, what is momentum? Momentum is the rate of change in price over time. So it's telling us, again, is price moving with force, or is it drifting sideways without a lot of strength here? Are the buyers or sellers in control of the price? And again, is the current speed gaining strength? Is it slowing down? Because price can move slowly in a trend, or it can be exploding rapidly. Now, at the end of the day, the main thing we do care about is price, and we don't necessarily care if it's moving fast or slow. But what we do care about is identifying, with that information, how much more likely is the trend to continue because of the momentum that we're seeing. So the main tool we're going to analyze here to measure trend, or to measure momentum, is the relative strength index. So the relative strength index, which I have below here, measures the speed and change of price movement. All right, there's several, that's an understatement. There's many momentum indicators that exist out there. We are going to be going into detail for most of them and how to use them and the differences between them in the momentum lecture. But the relative strength index is the most famous, most widely used, and thus this is the example that we are going to give. So the way that the relative strength index works is it is measuring the speed and change of the price moves on a scale from 0 to 100. You can see the scale on the right. Now, most values exist between a reading of 30 and 70. So the main essence that it works in theory is that a reading over 70 is saying that the trend is overbought, while a reading below 30 is saying that the trend is oversold. Now, the main thing to know is an overbought signal does not mean it is a sell signal, and vice versa for oversold. Because in a strong uptrend in particular, we could be in an oversold signal for weeks, months, as long as you can imagine. All this is saying is that the trend strength, or the momentum strength, is very, very high. And in the long run, right, you're not going to see an overbought momentum strength for a super, super long time, because eventually it will lose steam. It can't maintain that. But often you will see what we have seen this last week or so, where we've been overbought for weeks and weeks and weeks. But then we had a pretty sizable price decline over a couple of days, that reset the relative strength index to where now, even though price is again at an all-time high, the relative strength index does not believe that we are overbought again. So this is why these trends and indicators are super, super important. So SPY in a really strong bull market can hover in the range of 60 to 80 for many weeks. And I've seen instances where we are in this range overbought for weeks and weeks while the trend marches higher. So this signal alone is not good to use. Don't be selling when we're overbought and buying when we're oversold. That strategy long term will not work. Now, the most useful way to utilize this tool is what we call momentum divergences. This is probably in my top 3 favorite ways to use technical analysis because it tends to be very accurate in the long term. There's instances that this doesn't work, and it's always probabilistic. I love divergences. How divergences work are seeing a divergence between the price trend and the price momentum. Here's an example of what we call a bearish divergence. So bearish divergence, I guess this will have to do. Bearish divergence exists when price appears to be in an uptrend with higher highs, while the oscillator, the RSI in this example, is seeing lower highs. Here's an example here. This wasn't technically an uptrend, but the price saw slightly higher highs, right? We were a little bit higher here, just ever so slightly. So price was seeing higher highs, while the oscillator at the same readings was seeing lower highs. Oh. This signals that though price is going higher, the strength or momentum of the trend is getting weaker. So it shows that we are more likely to reverse than to continue higher. This was amazing technical analysis at the start of the year before the downtrend. A great example of this that I've seen, go back a little bit more, was at the end of the bear market and the beginning of the bear market in 2021, 2022. So the longer time frames you use, the more reliable the analysis becomes. Okay? So we're on the weekly time frame. So in 2021, we were making higher highs, higher highs, higher highs. This was a good example here. Much higher highs. Yet on the RSI, we were seeing lower highs. Price was going higher while the relative strength was weakening. This is a textbook bearish divergence, and this played out fabulously. And then to the flip side, one of the best bullish divergences I have ever seen was at the end of this trend where we were seeing much lower lows in the price while we were seeing much higher lows in the oscillator. This is a fantastic example of bullish divergence. We also saw that this year and at the end of last year where price again was making higher highs on the weekly and lower highs, much lower highs on the oscillator. This was another amazing bearish divergence signal. So something else to keep in mind as well. Now, there's a lot more I want to cover with momentum, but I do want to save a lot of this for the momentum lecture. I have a lot planned for that. So I'm going to talk about some of the recaps, takeaways here, and move on just to make this lecture reasonable length. The main recaps here are momentum equals the speed. Okay, this is measuring how fast and strong the price is moving. Indicators like the RSI and MACD, another indicator we are going to be diving very deep into. These are the most common tools to track the shifts in momentum and predict trend movement, right? Divergences. These are signaling trend exhaustion before price confirms it. Amazing tools. Every trader should be using divergences in their trading consistently. You also want to be using the relative strength or momentum tools to identify a trending market versus a consolidating one. And momentum indicators are best used when combined with price structures and volume for additional edges. So, some of the most common examples of momentum indicators that we are going to look at, especially, again, are the RSI, the MACD, the stochastics oscillator, it's a big one, the CCI, the Williams percentage, momentum, MOM, and tricks. Again, these are some big ones. Can't wait to dive into these more and explain how each of them actually works mathematically in the future momentum lecture. Okay, and next we are going to look at volume analysis. This is the third major tool of technical analysis. Many people consider volume to be the most important. I think it's important. I don't think it's the most important thing, but volume is really the only truly objective confirmation tool in all of technical analysis, as it is absolute. You cannot debate what volume will be or has been. So price can move on low volume, as we see many times, but sustainable long-term moves only will happen on strong volume. So volume is revealing the level of participation in the market. So this is the volume overlap here. Obviously, this is showing how many shares were traded per day. It shows you in the millions on the side. You can go line up here, get a good idea of what the volume was on any given particular day. So anytime one trade happens, meaning one buyer and one seller, if you were to buy one share of QQQ for 574, that means there was two people involved. There was you, the buyer, and someone else who is the seller of that share. So it takes two people or two firms or whatever to be involved for one volume. So as you look at this chart, this shows you volume over time. We've seen volume elevated in 2025 compared to past 2024. We had volume spikes, but on average, you can see the volume was a lot lower, whereas we've seen a lot of volume spike in 2025. Now, volume doesn't say who is in control per se. Price alone does that, but volume says how many people participated in the battle to get price to where it was. So volume will help answer, is this move real or is it fake? Right? Are institutions involved, or is this a low liquidity move? Is a breakout about to explode or fizzle out? Again, are traders absorbing the price? Are they dumping the price? So price going up on high volume, that shows strong demand, where price going up on low volume can be a suspect rally. So you look here, this is a really good example, right? Price fell sharply through the first couple of months of 2025. We saw a lot of seller volume. Let me get my line tool. And as the price continued lower, you can see in general, volume was increasing. Then we saw a brief rally in March, but this rally was on decreasing volume, showing this rally was not very strong, and ultimately we went substantially lower on increasing volume. Again, now this is important because then you can see we had some massive green candle days with some of the highest volume on record. What does this show? Well, this shows that as strong as this trend was, the highest volume conviction days were on these buying days. We then pulled back again, but look where the volume stood. Well down from even the beginning of this downtrend. Strong signals to show that this downtrend was coming to an end. And some even modern examples that could potentially mean something is we saw some high conviction selling, and ultimately we've seen a 5 or so day rally, but the rally has occurred on declining volume. So what does that mean? We don't know, but this is not necessarily what you want to see for an uptrend that is continuing after a pullback. So we could continue higher, but in this example, we're seeing volume declining despite price continuing to go higher. So something else to know about volume is you will often see volume extremes at the changing point of price. So the first example I can show is we had this downtrend here, right, before we ultimately had a small rally, before we topped out on this candle on March 25th. Well, if you look at the volume for that day, this was an extreme low volume relative to what we had been seeing, a signal that the trend was about to reverse. And in the other direction, we continued lower, while the high extreme was this volume here, which also coincided with the beginning of a new trend. So major extremes or major highs or lows in volume will often and pretty close to often be the point where we either top out or the point in which we bottom out. And you can also see the same thing happening with this trend here, right? We got extreme low volumes, the low volumes basically of the last couple of months on the day, almost to the day that price topped out. Similar to momentum divergences, you can also have volume divergences. This occurs again when price moves higher or lower, depending on whatever trend you're trading, and you're seeing volume continue to drop. So this is an example here. Again, we don't know what's going to happen, but this is just a good example I can show of what you don't want to see, where price is continuing higher, yet the volume is declining. And usually in strong uptrends like we are seeing, you'll see pullbacks on low volume. So the fact that we've had a pullback on high volume in the last week is interesting and not typical of a rally like this. So some of the volume indicators that we are going to be looking at deeper, we're going to look at a volume moving average, so it can again show some abnormal values in volume. We're going to look at the OBV, which is the on balance volume, some cumulative volume indicators, which is awesome. The volume profile is amazing. I can't wait to dive more into that. We'll see the point of control and some other things. But these tools are all existing and exist to help us identify value zones. So we can find low volume rejection zones or points in the price where the most volume happened, as we'll often see those levels act as support and resistance. Another major tool and usage of volume is to identify when institutions are getting involved. When you see massive spikes in volume like we saw here, this is not retail. Retail does not have the buying power or the capability to have a type of volume day like this. 160 million shares traded is outrageously large. This means institutions were fundamentally involved with price on this day, and you don't usually want to be trailing institutions. Or not trailing, you don't usually want to be going against institutions. So it's instances like this where you can see what the big money is doing and you want to try to follow what the big money is doing. Now, some of the other major mistakes of volume trading is assuming that high volume is naturally bullish. Obviously, this is not the case. We see high volume being massive sell signals a lot of the time, right? Ignoring volume at some key breakout or support levels. This is also a big no-no. Or overreacting to one volume candle without a trend context, right? This candle alone, without seeing the context of everything else, could have been highly misleading. So a quick recap for volume before we move on to volatility is volume is the participation of the market, right? This is confirming how price, right? Divergences in volume can mean be cautious. It doesn't necessarily mean the trend will reverse, but it is a signal and sign to be cautious of what is to come. Institutions will display their thesis for the market by massive volume spikes to always be so you should always be aware of that. And if you can combine volume into trend, volatility, and momentum in other indicators, you can get a much better signal of what is to come. So again, some of the tools we will be dissecting in the volume lecture will be the OBV, right? That's one we just talked about, the accumulation and distribution, spike detection, the volume profile, which is my personal favorite, the heiken money flow, the money flow index, and the ease of movement indicators. All of these are going to be touched on in the volume lecture, and I can't wait to share it with you guys. And last but not least, we are taking a look at volatility. So, volatility is the range of price movement over a given period here. So, it doesn't care about the actual direction up or down, it is only measuring the magnitude of the moves in either direction. So, a good example would be a $5 move in, say, Apple is going to be a lot more volatile than a 50-cent move. A quiet, slow moving stock like, say, Coca Cola may trade in a 10-cent range all day. It's a little more than that. I'm just using an example. But a volatile stock might move 10% every day in either direction. So volatility is measuring the projected movement in a price, whether to the upside or the downside, or in general, the range at which price is likely to stay in over a given period. So the example that I have here is the Bollinger Band. All right. The Bollinger Band is plotting two standard deviations above and below a moving average, meaning that over 90% of all price movement for the coming day or whatever period is likely to fall within the range of the Bollinger Band. When price goes above or below the Bollinger Band, it means that price is more volatile or moving outside of the projected range that price was projected to be within. So something you can use is the ATR. This is the average true range, probably the most common volatility indicator. I don't have it here. We will, again, something to go over a lot more detailed in the volatility lecture itself. But this essentially is showing the average range from high to low of price over X periods. So in volatile periods of time, that is going to be a large number. In non-volatile times, it's going to be low. So for SPY, the S&P 500, during COVID, the COVID crash, the average true range was about $15. So from high to low, you could expect $15 of price movement overall throughout the day. While in late 2023, during a raging bull market, that level fell to $2.80. So what you're looking at is, as that range expands, it shows you, one, what the market projects price to stay within a range. So options contracts and whatever that are further and further out of the money are going to be more expensive, because the probability that those price levels are hit goes a lot higher when volatility is high. This is the reason that volatility or implied volatility increases the price of options contracts, because these contracts that are normally way out of the money are a lot more likely to hit and make a lot of money. So volatility does increase the price of options contracts. Again, a high implied volatility shows a lot of uncertainty and event risks, while a low implied volatility shows complacency and calm. Low implied volatility periods are periods where you should be purchasing either short-term hedges to the downside or to the upside technically, but usually downtrends have higher implied volatility than uptrends, because downtrends happen a lot more quickly. If you look through history, the market takes a long time to go up, but can erase years of gains in honestly just a couple of weeks, as we saw here. Again, the volatility goes through multiple cycles, the main one being the expansion and contraction cycle. Here's a perfect example of that. The Bollinger Bands will show this clearly. When the closer the Bollinger Bands are together, shows that the market is implying less volatility in the future. So as they are getting closer and closer together, as we saw peaked out here, the market was not implying a lot. But then we sold off tremendously, and we saw them separate deeply where they were very far apart. This shows, again, that the market was expecting big spikes in the average true range, and that the potential for price in either direction was much wider. So in periods of high volatility, there is a lot greater reward to being correct on a trade, right? As you see this wide expansionary volatility period here, the risk to reward was huge. Not necessarily the risk to reward, but the risk was huge, because it is implying a massive move was to come, and that ultimately is what happened. And thus we contracted again, as now the trend is set in stone. The market does not expect, at least now, a major move in either direction. But the risk is also very large, because in a move like this, if you're wrong on direction, compared to, say, here, it's a big deal. If you're wrong here, the market implies you're going to be wrong by a little bit because price isn't expected to go dramatically in the other direction. While here, if you're wrong, it could be catastrophic as the market is expecting price to go in one direction very rapidly. So if you're wrong about the direction, it could go against you very large, very fast. So yeah, the higher volatility gives you that higher reward, also a lot higher risk. So in periods of high volatility, stop losses have to account for that noise as you're more likely to get stopped out of trades and positions the more higher volatility is. So if we're looking at, say, NVIDIA, right? NVIDIA could drop 6% in a day. We've had volatile days like that. Big opportunity to buy, but if you're using a tight stop loss, you might get stopped out of a trade before we continue higher. So the lower that volatility goes, the more likely we are to be in a bull market. There's a lot of reasons as to why volatility is closely tied to fear and risk in the market. So as people get more fearful, you tend to see volatility increase as price starts to become more erratic. The main index people use to track volatility is the VIX. Talked about that before. We're going to talk a lot more about the VIX in the volatility lecture. A high VIX, again, shows fear, but it really is showing projected high volatility in the coming 30 days. A low VIX is showing complacency and a lot more likelihood for a longer uptrend. So VIX spikes can show market stress and could signal some near-term reversals, while a VIX collapse shows confidence in the market and it's time for risk-on behavior. Now, the biggest mistake that I see in volatility trading is trading high volatility names with big size in hopes of big rewards. Now, the problem is if the volatility expands without the volume, right, it can be a major, major fake out. You can get really, really hurt. I've seen a lot of people lose a lot of money buying stocks that drop, say, 20% in a day for some earnings report, buying at, cheap. That's what we saw with UNH recently. It's fallen tremendously, been very volatile. People have been buying it because they think, okay, well, it's on sale, it's a discount. Then they'll buy it and then it'll drop another 10%. I've seen a lot of people get really burnt on these types of positions. Another mistake I've seen is using stop losses that are too tight because usually we want to protect ourselves from the downside, but in volatile periods like that we saw here, a tight stop loss would have almost certainly stopped you out because we moved dramatically in both directions. Another one is not adjusting expectations for volatile days like CPI, FOMC meetings. We're going to naturally see higher volatility on days like that. So volatility is a double-edged sword. If respected, it's a very useful tool, but if it's ignored, it can absolutely blow your account out. So quick little recap on volatility. Volatility is essentially the expected range of price. It is measuring the size of a move, not necessarily the direction of the move, right? The ATR and the Bollinger Bands are the most common indicators of volatility. We will go much further into both of these later on, right? We will see periods of volatility expansion followed by periods of volatility contraction. Periods of volatility contraction will last much longer than expansion overall. And the VIX is a major market fear gauge, and it is used to project the SPX volatility over the coming 30 days. So some of the example indicators we're going to touch on in this lecture are going to be the Bollinger Bands, the ATR, standard deviation, another fascinating mathematical concept, the VIX, the Keltner channels, another one of my favorites, the choppiness index, and the chandelier exit signals indicator. These are all major good tools to track volatility, and I really can't wait to measure all of this with you guys. All right, that should be everything that I'm going to touch on today. Again, brief recap, we touched on the two dimensions of the chart, which is price and time. And we also touched on the four major types of technical analysis, which include trend, momentum, volatility, and volume. Again, these were brief recap lectures of what to expect in these coming lectures for each of them. In the next lecture, we're going to be deep diving into support and resistance. We'll be touching on price zones, key levels, market psychology, gaps, which I love trading gaps, and why individual levels form. For this lecture that I am uploading right here, I have quite a lot that will be going along with it as major key takeaways for this lecture, as well as all of the terms to know. I have many that we talked about in this lecture, as you know, and I do want to have a vocab sheet for you guys to refer to if you are confused with some of the terms. Other than that, thank you for sticking around. This has been a long lecture, but I'm glad that you guys stuck around to watch it this far, and I cannot wait to bring you guys some trading strategies and the rest of this long module.